Hey guys, welcome to the final episode of this module, and we have come a long way, haven't we? Now, a lot of people will tell you which stocks to buy. A lot of courses will tell you how to choose a stock, but we don't get enough literature on which stocks to avoid. So in this episode, in this video, we will tell you about the red flags to watch out for before you invest in any company. So let's go through them one by one. The first thing you should look at is inconsistent revenue and profit. When you look at a company's financial statement and you look at the growth rate of a company, you should check whether the revenue and the profit is consistently growing. A fundamentally strong company will have a consistent increase in revenue and profits also. While there can be a few bad years where the revenue and profit will drop, but an overall consistent curve should be there, an increase should be there constantly. Now, if you find that the revenues are highly inconsistent, sometimes more, sometimes less, you must treat this as a red flag and investigate further. The exception here are commodity companies. Why? Because commodity companies often face inconsistent revenues due to volatility in commodity prices. The second thing we look at is debt. Now, a company needs funds to stay operational and grow. The company is expected to use its profits for these purposes. But however, on most occasions what happens is that the companies have to opt for loan to finance their growth plans. Now, as an investor, it is crucial for me and you to understand that some amount of debt is acceptable as long as the company can service its loan obligation and has enough cash flow, so a high debt to equity ratio should not be an issue. But if you find that companies are consistently increasing debt to equity ratio, then the chances are that it is financing its growth aggressively using debt. So in these cases, it is essential for us to compare the debt to equity ratio to the industry average. One can also check the interest coverage ratio. Now, interest coverage ratio is simple. It basically means it is an indicator of the company's ability to pay its cost of debt or interest cost. Now, it answers the question, how much debt is too much debt for a company to repay? A good interest coverage ratio is considered important both by market analysts and by investors, since a company cannot grow and may not even be able to survive unless it can pay interest on its existing obligations. The higher the interest coverage ratio, the easier it is for a firm to manage its loan. If the interest coverage ratio is less than 1, it basically means that the company isn't able to generate enough profit to even pay off its interest expense, and this is a massive cause for concern. The third thing we look at is promoter holding. Now, promoters are basically insiders in the company. They know about the company inside out. Now, if the promoter holding is decreasing steadily, then it is a red flag. It may mean that the promoters feel that this is the highest the stock price may have reached given the future potential of the business, and it is a red flag that must be carefully analyzed. If the promoters have taken a loan against their holding in a company, then it may be a red flag also. Because if it's a very small percentage of the shares, then it might not be a red flag, but if it's a large percentage, then it may be a big red flag. The next thing we look at is poor corporate governance. Governance or corporate governance is the foundation on which a company is judged. It means that the company is transparent in its actions and treats all stakeholders respectfully and fairly. This is a little more subjective than analyzing the financials of a company. Here are some red flags that you should look at to indicate problems in the governance of a company. If there's any revenue leakage, then it's a problem. Companies where there is suspicion of attempts to influence stock prices or manipulate it, big problem, right? Unethical business practices, not good, right? Lack of alignment with the interest of minority shareholders. They might do something else and not for the minority shareholders, big problem. And aggressive accounting policies to window dress financial statement. Window dress means make it look very beautiful when it's actually not. So those are some of the problems. The next thing we should look at are legal and tax issues. This is another red flag. Now, this should be an obvious red flag, but many investors tend to miss it since there is so much to analyze in a company. Now, a company is required to display all the information about pending lawsuits to investors. Now, you can find this information on the company's website also. Now, if you find that there are any pending lawsuits against the company or directors, it should serve as a red flag and demand a detailed understanding of the case. Another red flag we see is stock price volatility. Now, price volatility means stock prices going up and down frequently for a particular stock, right? Now, this need not necessarily indicate a problem with the company, but deserves some little more investigation since investors react to a market condition. Now, it is important to know what are the factors that are contributing to this volatility and why is it going up and down, so we need to analyze more thoroughly. Now, one of the most common reasons for price volatility is if the promoter holding is too high than the common stock in circulation, right? If promoter holding is too high, then the public stock is very less. So it is called low free float. Now, when a company has low free float, it is easier to influence the stock price as even a small volume trade can result in a large price change. Now, these stocks can be extremely risky, so be careful. Next red flag is too good to be true financial numbers. Now, some financial numbers can be too good to be true. For example, you might see a sudden jump in revenues 10 times, 5 times, even profits will jump so much, right? But you need to compare peers and find a particular company reporting exceedingly high profits compared to its peers. Now, if you're saying that this is giving too much profit and the peers are not, something's fishy. Now, this needs to be investigated further. If your investigation reveals that the numbers are true, then maybe this company has a competitive edge that is making it damn good compared to its other competition. So please go through it very thoroughly. Now, another thing we will look at, red flag, is shrinking profit margins. Now, net profit margin is a financial ratio used to calculate the percentage of a profit of a company that produces to its total revenue. Okay, it measures the amount of net profit a company obtains per rupee of revenue gained. Now, operating profit margin is a profitability of performance ratio that reflects the percentage of profit a company produces from its core operations. Now, it is calculated by dividing the earnings before tax, interest cost, depreciation and amortization, also known as EBITDA, EBITDA, by the revenue of the company. Now, depreciation and amortization is the practice of expensing a fixed asset or an intangible asset over its useful life. Now, if we look at reducing operating and net profit margin, even if the revenue is rising, shows that the company might be losing its pricing power over its competitors. Now, once profit margins start going down, then often what happens is they keep failing as rivals will fight harder and try to steal their entire market share. So that is not good. Profit margin should always go up. Now, finally, to conclude, that's it for today's episode, and I'm so glad to say that this was the last episode of this module, and just to look back and think how far we have come since the first episode of Grow Academy. And with the end of this module, you are now fully capable of analyzing a stock and an industry. So how does it feel, right? Well, I'm feeling very happy today. So let me ask you guys a question. Have you noticed that when the RBI changes interest rate, it has an impact on the stock market? A sudden hike in GDP projections can actually cause the stock market to rise. Why does this happen? It's more on the macroeconomic side. Now, in the next module, in the next few episodes, I am going to talk about macroeconomics link with the stock market. So if you're excited, I'll see you soon.